The Subcommittee on Housing and Insurance will come to order. Today's hearing is entitled Sustainable Housing Finance, the Role of Ginnie Mae in the Housing Finance System. Without objection, the Chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for purposes of making an opening statement and questioning our witness. The Chair now recognizes himself for 5 minutes. I want to thank our members and our witnesses, or our witness, for participating in our 4th hearing on housing finance reform. I look forward to hearing from Mr. Bright. While both Ginnie and the GSEs have enjoyed the backing of the federal government, Ginnie finds itself in a different position today than Fannie Mae and Freddie Mac. I understand that part of that is because there's a difference between the implicit and explicit guarantee, but I also believe it's because of the structure in which Ginnie provides mortgage-backed securities versus the system employed by Fannie and Freddie. Since the financial crisis, Ginnie has seen a significant amount of growth, yet has still been able to put the private sector in a first-dollar loss position. I hope to hear today how Ginnie has been able to manage their growth, which has been significant, and the responsibilities to the American taxpayer. I also want to explore the Ginnie model more in depth as we look to reform the housing finance system and bring more private skin back into the game. Mr. Bright himself has authored a proposal with former FHFA Acting Director Ed DeMarco to stand Ginnie up further in its role in the housing market. With now time at the helm to evaluate Ginnie's inner plumbings, he is in a unique position as to whether the suggestions made in that paper would actually work. Do the logistics make sense? Exploring a model in which the federal government is in the $4th loss position and whether there can be more levels before the federal government is expected to pay out should be a primary goal of any housing finance reform endeavor undertaken by this committee. Another area that has been highlighted in the written testimony, and I hope to discuss today, is the Ginnie Mae 2020 initiative. While we know that a large investment has been made in the common securitization platform, Ginnie has successfully employed its own platform that hundreds of private sector participants have been able to utilize. While the GSE's common securitization platform was originally intended to be utilized by more market participants than Fannie and Freddie, it has changed direction since Mr. Watt has been in charge of the FHFA. Are there similarities between the two platforms? And can one be utilized by both Ginnie and the GSEs? As I have said in previous hearings, I think we need to move forward with housing finance reform in a bipartisan manner. I hope today's hearing will help inform members on both sides of the aisle what Ginnie's future role is in the housing finance space. I would just note that Mr. Cleaver and I have had a number of meetings and are trying to move forward in a bipartisan fashion, and we're painting off the same picture, at least to begin with, which I think is a pretty good start. So with that, I now recognize the ranking member, Mr. Cleaver, the gentleman from Missouri, for 3 minutes, or 3 minutes.
Thank you, Mr. Chairman, and thanks for the hearing, and thanks for the interest and time you have given this issue. And I want to welcome you, Mr. Bright, to this hearing, the role of Ginnie Mae in the housing finance system. And the Housing and Insurance Subcommittee has held, as you probably know, a number of hearings this year on the state of our housing finance system. As these conversations continue, and some of them are continuing out of sight, just so that we can get down into the nitty-gritty on where we stand on these issues, I think it's important for us to hear from you on the role of Ginnie Mae in our current housing system. And Ginnie Mae has a large footprint in a small office, and because you're connected inside HUD, you have less than 200 employees, and I think that we appropriate funding for the salaries in Ginnie Mae and the expenses, the claims, and the capital reserve fund. That I'm assuming that they are funded through your fee revenues. But given the small amount appropriated to the agency, it's important, I think, for us to determine if Ginnie Mae is sufficiently funded or whether or not there is a need for some adjustments. Additionally, Ginnie Mae is engaged in a modernization initiative, which I appreciate, and I'm interested to hear more about this during the course of the hearing. Any plan to reform the GSEs must include an explicit government guarantee, preservation of the 30-year fixed mortgage, and strong affordability goals. That's what I've shared. Chairman Duffy and I have talked about that as well. And so getting a better understanding from you today will help us understand proposals that might be forthcoming. Thank you, Mr. Chairman.
The gentleman yields back. The chair now recognizes the gentleman from Florida, the vice chair of this subcommittee, Mr. Ross, for 2 minutes.
Thank you, Chairman, and I thank you very much for holding this hearing, and I commend you on your dedication for finding a better way for taxpayers and homeowners alike. I'd also like to thank Mr. Bright for being here with us today to share his insights from his current role as acting director of Ginnie Mae and years of experience in the field. The United States has been a beacon of freedom in the world, and a big part of that freedom has been the freedom to take risks. If an entrepreneur has an idea that involves a bit of risk, the American system has replied, "Go forth and God bless." Risk-taking and the entrepreneurial spirit is a fundamental part of our tradition of free market competition. Unfortunately, these days, some of the risky big ideas aren't coming from entrepreneurs. They're coming from bureaucrats and policymakers. That means that the collateral isn't one person's house or his credit. It's the taxpayers' dollars and our children's future. And rather than say, "Go forth and God bless," it's the duty of this body and the House of Representatives, and in particular this committee, to say, in the words of Lee Corso, "Hold on, not so fast." Right now, our housing finance policies are exposing taxpayers to a level of risk that cannot be justified or tolerated. With Fannie Mae and Freddie Mac on track to have their capital reserves deleted by year's end and nearing a decade in conservatorship, it's high time for this body to produce solutions that pave the way for a sustainable future. This brings me to Ginnie Mae, whose experience in the years following the financial crisis I believe to be invaluable in informing our reform effort. As a governmental agency, Ginnie Mae has a political mandate to help people achieve the dream of home ownership, but it also has a fiduciary duty to protect taxpayers against precarious risks that will lead to bailouts. With regard to achieving that balance, Ginnie Mae has done relatively well given the restrictions and directives that have complicated its missions. My hope is that this hearing will provide members of the subcommittee with additional insight as to how we can build upon Ginnie Mae's strengths and address its weaknesses. I believe as members of the House, we have a responsibility to ensure that the taxpayer is protected. I believe that this hearing will get us closer to a plan for protecting taxpayers against unnecessary risks so we can better stabilize our housing market. I yield back.
The gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman, for 2 minutes.
Thank you. I don't buy the idea that if it's not broke, don't fix it, because sometimes you can make things better. But if it's not broke, don't break it. We now have a system of 30-year fixed rate, prepayable mortgages available to ordinary Americans on good terms. Let's not break that. We have a system where the federal government can earn a profit in most years, put that profit aside, and be sure that it will more than cover losses that could be expected. If it's not broke, don't break it. Now, we were traumatized, not just economically, but in terms of our social fabric, by the bailouts. That's when you bail out a private enterprise. And we have to avoid creating enterprises that on the one hand are private and the other hand expect a bailout, whether that be AIG or Lehman Brothers, Goldman Sachs, or Fannie and Freddie. That's why I think we should strip the veneer of saying that Fannie and Freddie are somehow independent, non-government agencies under conservatorship and acknowledge what they are. They are government agencies and should be treated as such. If they produce a profit in a good year, that should accrue to the taxpayers. And, of course, the taxpayers are taking the risk. I look forward to learning how Ginnie Mae can be improved, but I'm not looking for some radical and disruptive change. And finally, I'd like to look at the servicing rights of loans, because I know a number of small banks have a good relationship with the individual borrower. They're not just a portfolio, and we'll want to talk about that. I yield back.
Very well, the gentleman yields back. We now welcome our one witness today, Mr. Michael Bright, the acting president of the Government National Mortgage Association, or Ginnie Mae. Mr. Bright, you will in a moment be recognized for 5 minutes to give an oral presentation of your written testimony. Without objection, the witness's written statement will be made part of the record following his oral remarks. Once the witness has finished presenting his testimony, each member of the subcommittee will have 5 minutes within which to ask Mr. Bright questions. You're well aware of this, but on your table you have 3 lights. Green means go, yellow means you have a minute left, and red means that your time is up. Pretty common sense. Your microphone is sensitive, so please make sure you're speaking into it. With that, Mr. Bright, you are now recognized for 5 minutes for an oral presentation of your statement.
Thank you. Thank you. Good morning, Chairman Duffy, Ranking Member Cleaver, and distinguished members of this subcommittee. My name is Michael Bright, and I am the Executive Vice President and Chief Operating Officer of the Government National Mortgage Association, or Ginnie Mae. Thank you very much for inviting me here today to discuss our mission and our work. Established in 1968, Ginnie Mae is a federally chartered corporation responsible for applying and administering a full faith and credit government backstop on qualifying mortgage-backed securities. In exchange for this backstop, Ginnie Mae charges lender fees and a 6 basis point guarantee fee, which is currently set in statute. The benefit of the Ginnie Mae model is that through a well-defined and limited government role, global capital is attracted to the U.S. housing finance system through all our market cycles. This reliable flow of low-cost capital purchasing Ginnie Mae mortgage-backed securities provides affordable mortgage financing for millions of borrowers. The easiest way to understand Ginnie Mae's mission is that we oversee a process for ensuring the success of the government's guarantee, often referred to as the government's wrap. Specifically, Ginnie Mae manages technology and infrastructure designed to track the payments of principal and interest coming from borrowers, going through the lenders, and making sure it ultimately flows into our common security on time and in full every single month. At its core, this is what a government guarantee means. An agency such as Ginnie Mae has regulatory authority over the process of ensuring the timely payment of principal interest on securities. To ensure that Ginnie Mae MBS remain liquid, we have extensive relationships with large investors across the globe. This helps maintain low interest rates for loans backed by the USDA, the VA, and the FHA, which ultimately get securitized into our program. A government wrap on MBS does not alone ensure success. I think this is an important point. At a very high level, the Ginnie Mae wrap works because we do 2 things effectively. First, we are transparent about our rules and our processes with our investors. And second, we work hard to police our program. Both work streams are vital to meeting our statutory missions of providing liquidity and protecting taxpayers. We are also successful in part because we have a nimble staffing model. Ginnie Mae was designed to have a relatively small core staff, leveraging specialized support from contractors where appropriate. Far from being a weakness, we actually believe that our outsourcing model in some ways has allowed Ginnie Mae to be scalable and to expand or contract as market conditions change. In our mandate to protect taxpayers against loss, we are helped by the fact that in the Ginnie Mae model, the government backstop is in a so-called fourth loss position. In front of Ginnie Mae are multiple layers of capital, including the balance sheets of our issuers. Mechanically speaking, Ginnie Mae's primary risk is that a lender fails to remit timely payment of principal and interest on a security. If this occurs, Ginnie Mae must make the payment for them. Then, similar to the FDIC receivership process, Ginnie Mae moves the lender servicing book to another lender. Missed payments or issuer failures are always a risk, but in practice, they are in fact quite rare. This was true even during the financial crisis. Right now, Ginnie Mae typically remits to the Treasury somewhere between $1 billion and $2 billion annually, which is reserved in an account at Treasury against future losses. To date, we have never needed emergency federal assistance to perform our job. We are always working to align our rules and our procedures with the shifting landscape of risk. In recent years, our issuer base has evolved from large banks towards smaller monoline mortgage banks that do not have significant balance sheet themselves. For Ginnie Mae, this poses the risk that multiple issuer failures could occur during a liquidity run in the markets. To protect against this, in late 2014, Ginnie Mae issued minimum cash liquidity requirements for all of our issuers. While that was a necessary first step, We are currently examining ways to further enhance taxpayer protections. Looking forward, Ginnie Mae is engaged in long-range planning for the future. As noted, we are calling this initiative Ginnie Mae 2020, and it is the next wave of strategic modernization for Ginnie Mae. While we will be officially unveiling the effort next year, the initiative focuses on technology modernization and enhancements to our counterparty risk management policies. One other recent development that I would like to quickly mention is our effort to curb aggressive and potentially abusive marketing by some VA lenders. We have recently formed a task force with the VA designed to bring a stop to abusive behavior that puts veteran borrowers at risk and raises the cost of financing for everyone who relies on the Ginnie Mae program. In conclusion, let me say that Ginnie Mae has proven itself adept at administering a government backstop on MBS since the agency began operating 50 years ago. With that in mind, Ginnie Mae is here to help policymakers implement whatever housing finance system that you deem appropriate for the future. Thank you, and I'm happy to answer any questions.
Thank you, Mr. Bright, for your oral statement. The chair now recognizes himself for 5 minutes. I just, in response to Mr. Sherman's comments in regard to if it's not broken, don't break it, I come at this with the premise that the system was broken, and it broke our whole economy. It broke American families. There is a problem with the structure of that old system that continues today, and thinking through reforms to make sure that we don't break the American family, again, I think is smart for policymakers. And the thought that we would, and I'm not saying that anyone's proposing this, but we're going to put politics and political decisions in front of market discipline, I think would be foolish, because in the end, you get a very bad result, which doesn't actually help the American people or the American family. It actually hurts them, which is what we saw in the 08 crisis. But Mr. Bright, you and Mr. DeMarco wrote a paper. You now sit in a unique position to maybe analyze the conclusions of that paper. Any thoughts or insights that you want to give us? Does your paper, would it still work based on your knowledge today? Could Ginnie Mae be the model that we stand up per your paper?
Sure. Well, yes, I definitely am not walking away from the paper. In fact, I would say my experience so far at Ginnie Mae, I believe in the conclusions and the model even more than I did potentially when we wrote it. I would say that you know, when Ed and I started talking about that, and it would have been 2014, 2015, the idea of using Ginnie Mae as a full faith and credit backstop as opposed to creating a new one, sort of the genesis of that idea was that the Ginnie Mae securities are already out there. They're $2 trillion in size. It's a very transparent price, so we don't have to have, you know, all kinds of back and forth about how much is a full faith and credit wrap worth in terms of lowering rates. Because, you know, in most reform proposals, you wrap mortgages with a full faith and credit wrap, and everybody says rates go down, and then you bring in private capital, which costs some amount of money, and so rates go up, and so there's this debate over what is the net impact. We kind of said, hey, let's just use Ginnie because we can see what the price is, so you actually kind of take that argument off the table. And that was sort of the reason that we did that. What I've learned since being a Ginnie is that there's even more to it, which is that a wrap doesn't just exist because we wave a magic wand and say all these mortgages are now guaranteed by the government. An explicit wrap, if it's going to work, needs people to oversee and administer it, to make sure that money is flowing. If there isn't P&I calculated properly and it's not in the account at the right time, you can go to your explicit account at the Treasury and put money in there and then go back to the system and say, you know, who messed up and why. And that is a process, that's an administrative process. That's what the folks at Ginnie Mae do. And that's really been, I think, kind of a little bit of a light bulb moment about how using not only using a brand that exists, but a set of processes and administrative functions that exist would probably, you know, make it the easiest way to transition to something.
Do you note any operational infrastructure challenges since you've been there?
We have to do some modernization. Where, you know, the mortgage market is moving towards this e-mortgage, e-note type process, and our architecture has some upgrades to get there. We have that slated actually for next year. We're procuring a contract to get that done. So we want to be able to do e-mortgage. There are some pool splitting capabilities that a lot of issuers said that they would like to have, which we are actually procuring as well. But they're pretty nuanced and technical. There's no sort of big picture, you know, anything major that I would say that Ed and I missed that I've seen since I've.
So the chairman and I, who is here for this hearing, have been talking to a number of different groups, trying to get their feedback and input on if we're going to do reform, what should reform look like, and there's a number of different models, including the one that you helped author, and we're soliciting feedback and input from all different players in the market. I think there's been a consistent concern by the smaller institutions having equal access to the secondary market. Can you address those concerns? Should they be concerned under your model?
Well, it's housing reform, so everybody's always concerned, and they want to make sure that they get it right and all these things. Ginnie Mae does have 450 issuers. Most of them are small. We do have standards for whether or not you can be an approved issuer. There's a process to it, but the vast majority of our issuers are small issuers. And in a Ginnie Mae security, you actually get all of the benefits of sort of cross-subsidization from large institutions, because every month, every loan that's originated and put into a Ginnie pool all gets aggregated into the same QSIP. So small lenders, you can deliver one loan, and you get the exact same price execution as if you're the largest mega bank delivering millions of loans. And so we think that that's the advantage of a single QSIP security based on the way that we have it. So we don't have specified pay-up trading, which the GSEs do, which I think disadvantages small lenders. We have a single QSIP, like I said, which aggregates all the loans every single month. Most of our issuers are small lenders. We work very hard to make sure that small lenders have access. So to the extent that there are concerns, we're certainly here to work through them. But at a macro level, we think we have something that should work for them.
Thank you. My time has expired. And I recognize the gentleman from Missouri, the ranking member, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Mr. Bright, I want to talk to you a little about actual differences in risk. And pardon me, I'm a little unable to use my beautiful voice as usual, but you're significantly different, maybe significantly is not a good word, but different than Fannie and Freddie. And can you concisely just give me the differences as you would see it?
Sure. Very different, actually. We have the similar sounding names, but very different functions. We administer a full faith and credit wrap on a security. Full stop. I mean, that is an administrative function, making sure that the bondholders know they're going to get paid, and that the issuers know the rules for participating in our program in terms of when they have to remit P&I, what data they need to give us. But it is an administrative function that ensures that a full faith and credit guarantee both makes investors confident in buying the security and taxpayers confident that there are risk controls in place, that we're not going to have to ask Treasury for a bailout. That's Ginnie. Fannie and Freddie, they buy loans from lenders, they pool them together, they put them into a security, they issue their own securities, and they have cash windows to buy loans from smaller lenders, and Fannie does the issuance for them as well. And finally, they have balance sheets where they buy delinquent loans out of pools. So, they're really, secondary marketing aggregators, credit enhancers, and cash window providers. So in some sense, their role is almost analogous to kind of what the FHA does in the Ginnie Mae program. Now, they don't operate with an explicit full faith and credit guarantee. They operated with what we all know is an implied credit guarantee. And mechanically, the way that implied guarantee works is that Fannie and Freddie can buy loans out of pools when they go delinquent by issuing debt into the capital markets at very cheap rates that are subsidized almost explicitly, and they raise that capital and they buy loans out of pools and put them on their own balance sheet. And our program, our private issuers actually do that, and we just guarantee the MBS.
How does Ginnie Mae approve issuers? What is the process?
Yeah, it's about a 4 to 6 month process that involves examination of management capabilities, examination of business plan, examination of an issuer's commitment to being in the servicing business, examination of an issuer's access to capital, liquidity, and financing, history of this issuer's sort of operational capacity. So It's not entirely dissimilar in some ways to the way a bank would be approved in that you present, there's a very thick dossier, I've looked through it, of
But it takes about 6 months.
about 4 to 6 months. We go as fast as we can, being as diligent as we can. That's right.
Now, Fannie and Freddie take on risk. I guess with Ginnie Mae, who's taking on the risk?
Yeah. So in Ginnie, the risk is bifurcated, or it is split very neatly into 3 different parts. Our issuers, which are private lenders, so think of mortgage lending institutions, have the risk that they have to remit timely principal and interest every month no matter what. So if you are a lender and you issue a Ginnie Mae mortgage-backed security, and some of the borrowers to whom you've made loans to don't pay you on time, you as the lending institution are responsible for getting P&I to us and into our MBS. Once that borrower, so that's risk number 1, and that's with the lending institution. Once that borrower goes more than 90 days delinquent, the lending institution files an insurance claim with the FHA, the VA, or the USDA. Those institutions then look and say, you know, are the documents in order? Is this a conveyable property? They have a series of checklists that they do like any insurance claim. And if everything is good, then the FHA writes a check to the lender and says, here, we owe you this money for the loan. This is what you had insured. So that's the FHA's risk, which is basically the credit risk and the risk that, you know, loans that were underwritten properly go delinquent, the claim gets filed, and you have to give them an insurance claim. Ginnie Mae's risk is that the process doesn't work somehow, that a lending institution has a liquidity situation and can't remit P&I, or delinquencies spike and there's a time lag between when an insurance claim can be filed and when that cash is actually there. In that case, the explicit wrap kicks in, Ginnie Mae puts P&I into the investor account, and then would kick an issuer out of the system because they missed the fundamental premise of our program. But it is worth noting that even in the financial crisis, we didn't really get to that layer. That layer of, you know, Ginnie actually having to dip into our reserve account at Treasury in order to pay a bondholder really only happens in the case of like a fraud or something sort of exogenous, because there are many reasons that you can get removed from the Ginnie Mae program as an issuer. Missing a payment, even by a day, is instant. You're no longer a participant. So that's really doesn't happen very often. But I'd be happy to go through
Yeah, thank you.
The gentleman's time has expired. The chair now recognizes the vice chair of the subcommittee, Mr. Ross, for 5 minutes.
Thank you, Chairman, and thank you, Mr. Bright, for being here. I'm very intrigued and even more encouraged by the DeMarco Bright theory in your paper. And as you talk about the last layer of responsibility under Ginnie Mae and how it has rarely, other than an issue in instances of fraud, been tapped, is it when we look at Fannie and Freddie and transforming them under the DeMarco Bright plan that this would also be the same? That this would be the level, the same tiers of responsibility, the private, or the mortgage insurance, the equity, then the mortgage insurance, and then lastly would be Ginnie Mae.
That was what the basis of the proposal was.
And my concerns are, and not for me necessarily, but for some of those that are very concerned about something like this working, is one is the capacity for private sector involvement with credit enhancements. Is there capacity out there to do this on the level that DeMarco Bright suggests through the Fannie and Freddie transformation?
Well, not tomorrow.
Right.
But yes, and over time there certainly would be.
How much time would you say? I mean, everything I understand, when we have the government been providing and subsidizing forever, you can't go cold turkey overnight.
That's right.
You have to transition. It doesn't matter whether it's flood insurance, it doesn't matter what it is.
Right.
If we're going to do that in order to build a market, we've got to give the path and then let the market develop as market forces do. So, 5 years?
Yeah, and that's kind of the number I was thinking, which actually corresponds to sort of the average tenure of a mortgage. So maybe that's a good way to target it. That would be about the amount of time that a loan that was originated today under an old system, maybe under a new system, would be getting insurance from Fannie and Freddie, as opposed to doing all the issuance stuff through Fannie and Freddie, but going through Ginnie.
And then let's say 5 years from now, we've got the private sector capacity where we're minimizing any exposure to the taxpayers. Let's go to the big question, and that's affordability. are we going to be able to have affordable mortgages under this particular type? And if so, if not, I'd like to know that, but if so, why would you say so?
Well, I mean, that is a critical boundary constraint, I think, both politically and on policies, that mortgages be available. There are a couple of things here, cross-veiling currents. The first is that the advantage of wrapping the market with an explicit wrap as opposed to an implicit wrap is you absolutely bring in.
You give the guarantee.
Yes, you have an explicit guarantee, which brings in a whole set of global capital that
is at a lower risk, less return, and so there should be more availability. Would you not agree?
Yeah, no.
And if there's more availability, would there not be more affordability?
That's the idea. That's correct. Yeah.
And then within 5 years, we could create this type of market and significantly reduce the trillions of dollars of exposure that taxpayers presently have under Freddie and Fannie.
I believe that would be true. Yes.
Let me ask you, with regard to flood insurance, because there are certain properties with a 100-year flood plan that are backed by both Ginnie and Freddie and Fannie that have to have flood insurance. But yet, we know that flood isn't abiding by the law and only go where there's a 100-year flood plan, as is evidenced in this last storm season. Do you know how many properties have been affected under Ginnie Mae by damage due to flood that were not covered in the 100-year plan?
I'm being told 150,000 properties.
150,000 properties that did not have flood insurance. Now, what impact does that have? How does that affect the liquidity and the solvency of Ginnie Mae?
That is not an insignificant problem, because if you have a property that has been damaged through a flood, and the property cannot get into a conveyable condition to file an insurance claim with FHA, it does raise the risk that the issuer, if they're concentrated in that particular geographic location, could have an insolvency situation.
Correct.
In which case, Ginnie Mae has to take that book and either put it on our own balance sheet or transfer it to somebody else, which is what we would normally do. It's important to note that in the current flooding, the disasters from this past summer, we're analyzing with very sharp pencils and all kinds of models and everything. Yeah, we don't see a problem for ourselves, and we're in constant.
Imagine what it's like for Freddie and Fannie. I mean,
right.
That's compounded exponentially, I would imagine.
So it's something that poses a problem.
I guess my suggestion would be that we need to look at an on all lines policy that is somehow or another offered throughout this country that includes flood, especially for those that can be more than affordable if they're not in the 100-year plan. I'm just concerned that we don't have the capacity to insure as a federal government, which we shouldn't be doing in the first place. But even if we're able to structure the market to where we have private sector through credit enhancements taking the bulk of the risk, we still have other risks out there that could impact us, such as flood and other natural disasters. Disasters. I yield back.
The gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Mr. Chairman, you point out that the system broke in 2008. I want to stress that isn't the system we have now. What we know fails is an implicit federal guarantee for privately run, profit-oriented institutions. That's why Fannie and Freddie, when they were run by private enterprise, but guaranteed by the taxpayer, led to failure. We have that current situation now with the too big to fail banks. They are run for private profit. Their executives are focused on stock options, and yet there is an implicit federal guarantee because the very words too big to fail imply that we will not allow them to fail. Two systems we know do work. One is if the federal government's not in a certain private sector area, such as technology, that works. And then in specialized areas where we want to benefit the consumer, where we want to achieve national, especially financial purposes, you may have government agencies. That also works. So the current system did not break. The system we had in 2008 did, and we shouldn't go back to it. Under your proposal, Mr. Bright, Ginnie Mae acts as a standalone corporation that issues explicit government guarantees to mortgage-backed securities with proper credit enhancements. The first 4% of the loss is absorbed by the private sector, as I understand it. Where'd you get the number 4%? And more importantly, because I know you had to pick some number, under this proposal, will home buyers be paying more?
Well, thank you, Congressman. So I apologize to take the caveat, but my day job is incredibly busy right now. I haven't read Ed and my paper in a little bit of time. My recollection is that the 4% capital that we had proposed was somewhat analogous to what the Basel standards were for banks, and so we were looking to try and not
more to the point, Ava, if we went with your approach, would we be paying a few basis points more when we financed our new home?
Our analysis, which had Ginnie Mae MBS trading about 1.5 to 2 points above Fannie's on par coupons, showed that rates would be roughly the same under the proposal as where they are today.
Now, Ginnie Mae has experienced dramatic growth in your MBS issuance. Do you have, and as I understand it, you're charging a fee, so money's coming in, but that money goes to Treasury, you can't spend it on salaries.
That's correct.
So you're doing a lot more. Do you need more appropriations, at least to appropriate back to you the fees you're charging? Or do you think that there's no risk in spending $23 million in salaries with a $500 billion portfolio?
$2 trillion portfolio, not to enhance your point, but
oh, wait, that was, no, excuse me, not portfolio, $500 billion issuance in 2016.
that's correct. That's correct.
Portfolio of 2016,
right.
Yes.
Well, so I don't know of any head of an agency that wouldn't say that they would like both more money and more flexibility in how they spend their money. So yeah, that's just kind of a baseline. There are a couple caveats to that. The first is that we do actually have a reasonable degree of autonomy, and actually quite a bit of autonomy in terms of how much we spend on contractor resources. Mm-hmm. So our fees come from two sources. There's a 6 basis point ongoing guarantee fee, and then so that's in rate, and then there's a 10 basis point upfront commitment fee that our lenders pay.
So you're in a position where you can't have employees, but you can have contractors. Does that bias you toward using contractors rather than employees?
It does have that effect.
Okay, and then finally, I do want to sneak in, since you've got the small originators who want to maintain that personal relationship with the borrower, is it wise to require them to sell their servicing fees? That's a point I brought up toward the end of my...
No, we want servicers who originate, service, and have responsibility for that loan all the way through in relationships with their customers. That's the best position for Ginnie.
Okay, so originators are not required to sell their servicing rights?
No, definitely. Definitely not, no.
Thank you.
The gentleman's time has expired. The chair now recognizes the gentleman from Michigan, Mr. Trott, for 5 minutes.
Thank you, Chairman, and thank you, Mr. Bright, for your time this morning. And I think your proposal and your solution regarding housing finance reform is attractive in part because of its simplicity. So I'd like us to spend more time considering it. But one aspect of the solution that's a reality is it's hard for us to get things done. And so given the political realities, another simple solution that I've been advocating for is just to get the federal government out of the refi business. And don't really see any reason why Fannie and Freddie and FHA should be involved in refinancing loans. If someone has a mortgage and they're paying, and it's a performing loan, and they want to get a lower interest rate, they've already are enjoying the dream of home ownership, and the government doesn't need to have a role in that. What are your thoughts on that statement and that solution?
Well, I haven't thought about that a lot in my current role. I think I hear you. I understand entirely the case that you're making. I suppose, and I'm thinking off the cuff here. I mean, I suppose a middle ground, if that, to consider, would potentially be, cash out refinancing. That might be something where you say, why is the government, incentivizing the removal of equity from someone's house? That would probably be where I would consider starting. But no, I understand what you're saying.
But let's assume let's assume it's not a cash out refi, it's just a straight up refi for a lower interest rate. You know, do you think FHA has a role in that? I mean, you know, is that something you think FHA, and then similar along the same lines, do you think the private sector would be interested in a security that had just refis in it?
Well, I do think that certainly there is bank capacity to do more lending, and would like to see more of that happen. I mean, I think it's better, you know, if we can figure out what barriers there are to having banks make loans and hold them on their balance sheet. That's something I think you all have been working on, and I applaud that work and encourage you to continue doing that. It's better for everybody. You know, the reason I think I distinguish between the cash out refinance and a refinance is that to the extent there isn't, let's say, a bank takeout for a loan, if you're in an FHA loan and rate, you're paying 6% and you're paying on time and you refinance to 3 or 4%, the likelihood of your default actually has gone down because your monthly payment has gone down. That changes if you take cash out. So that's where I would start to think about potentially a distinguishing factor from where I sit now, which is just to look at the risk in the system.
Well, but again, yeah, I appreciate what you said, and I agree with everything you just said. But again, if you start with the goal of reducing the footprint of the federal government in housing finance, a simple solution would be just to get them out of the refi business. 2/3 of Fannie Freddie's portfolio are refis. And if you look at the FHA program and allowing, you know, first-time home buyers to realize the dream of home ownership, that's not a refi. You know, that's already, you know, been taken care of, and now we're just, and the only argument I've heard that really resonates is in discussing this with my friend from Massachusetts who's not here. You know, he strongly opposed that suggestion of taking the GSEs and FHA out of the refi business. I can make an argument for our veterans that maybe we don't go there, but his argument was basically you look at someone who's a low to moderate income family, and that refi is their solution to how to make ends meet. And so the counter argument to that point is basically, and this is my question to you, perhaps you can speculate on what the impact on rates would be if the proposal I've outlined came to fruition.
That you could not refinance?
Right. You have to go to the private sector for a refi. What do you think they...
Well, if you couldn't do that, I would say MSR values would certainly go up quite a bit because the prepayment risk is the biggest challenge in MSR valuation. So that would certainly have a very large economic impact. What maybe, since I've not thought about this or talked to you, I mean, maybe we have this conversation and I'd be happy to give it a little bit more thought, put some numbers on it, and I hear your point for sure.
Yeah. And I'm out of time here, but again, if the impact on the refi rate is de minimis, then my friend from Massachusetts' argument is not compelling either. And with that, I'll yield back, but I sure appreciate your time and insight because I have great respect for your knowledge. Thank you.
Thank you.
The gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
I passed my time.
The gentleman passes. The chair now recognizes the gentleman from New Jersey, or no, from Illinois, Mr. Holmgren, for 5 minutes.
Thank you, Chairman. Thank you so much, Mr. Bright, for being with us today. Your testimony, you mentioned that Ginnie Mae does not have many tools or dials we can turn to determine how big we are. I wonder, do you have any immediate concerns about the recent or expected growth of Ginnie Mae? If you could talk about that a little bit. And then, what tools are there? You say there aren't many, but what tools are available to control its size and overall risk exposure? And then do you believe any other tools are necessary to protect the longevity of the Ginnie Mae model? And do these require action by Congress?
Yeah, thank you for the question. The growth number itself isn't on its own concerning per se. I think you want to understand why it's growing and what you're doing about it. So there's no doubt that there's a confluence of factors taking place at Ginnie where we've had this growth and we've had a shift in our issuer base at the same time. A lot of this occurred before I came here, but I will commend the Ginnie Mae staff. We have an incredible group of senior managers at Ginnie who have really instituted a series of sophisticated risk management tools. We have something called Corporate Watch, which brings in all kinds of data about all of our issuers. We kick the tires on these issuers sort of all the time. They've instituted a liquidity rule, which was not without, controversy or kicking and screaming or whatnot when it happened. We're looking at additional sets of liquidity requirements and tailoring the liquidity requirements. And we have a list of kind of additional issuer risk that we're making part of our 2020 proposal. So we're very aware that with greater size comes greater risk, especially when your issuer base is shifting. Mechanically speaking, our systems are volume agnostic, and so they can do 20 million borrowers or they can do 20,000 borrowers, and it's sort of the same process. So it's not on its own a risk. What we really need to do more work on, and I think where we're going to focus a lot of our energy over the next few years is, do our issuers have access to the liquidity that they need so that if there's a hiccup, they can continue to make payments? And how good is the collateral that Ginnie Mae has? Because our collateral is the MSR as an asset, so that if an issuer fails to live up to their obligations or worst case scenario miss a payment, we go and we take that MSR, and that asset has value. So it's a strip of 35 basis points of IO for some number of years, and it has got a net present value, even if there are high delinquencies. And we go to another lender and say, would you take this book? And often you can sell it and have it to the highest bidder. Sometimes the value is zero, and so you just transfer it. And in a worst case scenario, that's what our reserve account for at Treasury is. We can transfer the book with a check. So what we really need to do is, regardless of the size, we need to know what the value of that MSR is, how it's being valued, how it's being serviced, the operational capacities of the servicers that are doing it, and what we would do with it in the event of an issuer default. And that's really where our energy is. It's not so much volume as it is quality of your counterparty that matters.
Yeah. Well, I think if I can dig into that a little bit more, you touched on it, but I wonder if you could discuss that reserve account that Ginnie Mae keeps at the Treasury Department. How is the size of that account determined? Do you believe the $20 billion in the account right now is sufficient? And do you believe that $20 billion would still be sufficient if we encountered a housing crisis or an economic downturn like the one that we saw 10 years ago?
All that happens is the 6 basis points that we collect on an ongoing basis on guarantee fees produces about, right now, it produces between $1 and $2 billion a year. It certainly produced less when Ginnie was smaller. That money just goes directly to the account. It is there and it builds up, and so it is currently sitting at about $19.5, I think, billion. It's a misleadingly small number in the sense that the only thing that money is there for would be to augment the value of a book if we needed to transfer it. So it's kind of like if a bank went insolvent, the FDIC doesn't buy the bank for the total value of the assets of the bank. The FDIC transfers the bank, which has some amount of value, and if that value is negative, it has to dip into its diff to do it. There's a lot of sort of analogies with the Ginnie Mae fund. I don't see any situations where there would be anything like $20 billion needed to transfer a 35 or 40 basis point thick MSR strip. I will caution that in 2007, no one saw any situations where housing prices would decline nationally either. So I'm very professionally and personally aware that just because it's never happened doesn't mean it can't ever happen. And so we try and look at every downside conceivable risk possible, even ones that we don't have empirical evidence have happened recently in the past.
Okay. I've got a few more questions. My time has expired. I may follow up in writing if that's all right.
Of course,
with that, I yield back. Thanks, Chairman.
The chair now recognizes the gentle lady from Ohio, Ms. Beatty, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member, and thank you to our solo witness here, Mr. Bright. Let me just tell you, I've been watching you from our cloakroom, and you're doing a great job. So we appreciate your service and all of the information that you have provided. As we know, in November 2016, under the leadership of the former director, Richard Cordray, of the Consumer Financial Protection Bureau, that there was a report on service members' complaints. And in that report, it highlighted approximately 1,800 service members' mortgage complaints concerning refinancing through the VA's housing program. As you know, Ginnie Mae guarantees the MBS for these programs. Specifically, many of these complaints concern aggressive solicitation, misleading advertisement, and failed promises to the lenders. In your written testimony, you recognize the rapid refinance and loan churning occurring with the VA. Refinances created downward pressures on Ginnie Mac securities, ultimately harming veterans by increasing borrowing costs. I was encouraged to see that Ginnie Mac and the VA announced a joint task force just last month to address these issues, and would like to ask you to keep this committee informed on your progress and inform us of any legislative reform needed to stamp out this abusive and predatory behavior. In my district, 3rd Congressional District of Ohio, just last week, I had an opportunity to participate in a field hearing with Senator Sherrod Brown from Ohio, and it was with veterans. And of course, one of the things that we heard was what happens to them in the whole industry of housing, in coming back home, trying to relocate, trying to get a house financed. And we heard some very compelling stories that weren't good about how they were treated. So I have been a huge advocate with legislation on housing, financial literacy with veterans. So one of the things I would like you to do is to tell us how we can do a better job, or what are some of the things, how you would respond to this criticism.
Well, thank you very much for bringing up the issue and the question. It is definitely a bad problem. It is a situation that needs attention from Ginnie, from the VA, and from Congress. And some of your colleagues in the Senate have reached out and want to address this issue, and we very much appreciate any help that we can get, both moral suasion, public pressure on lending institutions, all of the above, legislation if it's deemed necessary. So this is a long conversation, and what would be great is if we could sit down, and I would love to talk to you about some ideas. But basically, Ginnie Mae can control the access to a Ginnie Mae MBS, and we are going to be. I don't want to promise before Christmas, but I'm pretty confident that this is going to happen. We're going to be announcing a series of steps that limit the ability for lenders to access the Ginnie Mae security if they're shown to clearly be churning loans. And there's no justifiable reason, with interest rates not dropping, that we would have pools of loans that would prepay in 5 months. I mean, there's no explanation. There's no economic explanation for that. There's gaming of the system that's taking place on the part of the lender. And that kind of stuff needs to stop. It does have the effect of making MBS investors less willing to buy Ginnie MBS, which lowers the price, which increases the interest rates for veterans, VA, and USDA borrowers.
Let me reclaim my time because we only have a few seconds. One of the biggest criticisms of the Bright DeMarco GSE reform proposal is that it could disadvantage small banks and community banks and credit unions, which I have a lot of in my district. How would you respond to that in that proposal?
Well, I would certainly want everybody to hear their concerns, and make sure that there's nothing that was missed in the paper. And if there was, then address it. There were a few features to it, though, that I think should have been community bank friendly. The first is that, like I said, in the Ginnie Mae program, we have 450 issuers. Most of them are small, and they get the value add of every month, every single loan gets in the same QSIP. So you don't need to produce large volume in order to get access to this security that's highly liquid. You just need to be approved to be in the program. Whereas when you have GSEs, there is a difference in terms of the way pricing can be done, treatment can be done, terms and conditions can be done. Ours are flat for every lender. And then a feature of that paper that I recall I think we suggested that new Fannie and new Freddie, or whatever you want to call them, would have to have cash windows for small lenders, and that they would be issuers of the Ginnie Mae security on behalf of those loans. And I think that was part of the idea there, was to help address their concerns. But certainly, it's a paper. It was 25 pages, and it goes into a multi-hundred-page piece of legislation. There would be more amendments, but glad to work with you on that as well.
Thank you, and my time is extended.
The gentlelady's time has expired. The chair now recognizes the gentleman from New Jersey, Mr. MacArthur, for 5 minutes.
Well, thank you, Chairman. I am most interested in not so much in reducing government involvement, but in the nature of government involvement in the housing sector. And I, like others, I've read your paper, and I hear you loud and clear that you're not looking to put a bill number on your paper and turn it into law today. I hear that. But one of the concepts that you flesh out that I think is pretty helpful is that you have a private primary market like you do today. You have a mutualized secondary market that's also controlled by the banking sector. That alone would be different from what we have today. And then you have what I would call a government reinsurance model, not unlike what Ginnie does. Maybe the mechanisms are different, but that would apply across the entire platform of Ginnie, Freddie, Fannie. Is that fairly stated?
Yes, that's correct.
So I'm most interested today in the third part, and I just would like to talk about, I guess, the moral hazard issue. One of the concerns I think I have, and certainly I think the nation should have, is we don't create a system where bad actors can write bad loans, make money today, and others can pay the cost of those bad loans tomorrow, and they're long gone. And so I wanted to hear your thoughts on how would a government backstop potentially function, a reinsurance model, however it's structured. How would we do that in a way that that mitigates that moral hazard, that doesn't allow people to not pay for their own errors?
So recognizing that it is the mortgage market, and so I understand that market is almost in quotation sometimes in this industry for a lot of reasons. But within the context of what we've got, the best, I think, attempts to eliminate moral hazard would be sort of twofold. The first would be, the explicit guarantee needs to do two things. It needs to have some regulatory and policing authority, and it needs to be run well. And I can't promise that an agency will always have good police and be run well, but whatever controls and processes and boards and governance structure we could come up with to help ensure that there are policing mechanisms so that you have the ability to take bad actors or people who don't look like they're in it for the long haul out of the game, that would be one thing. The second thing is that this guarantee, it does have this feature of sort of actually serving as a traffic director in a reformed system between the interest rate investor and the credit investor. So you need both investors, and you want both investors to be in the system. And in some sense, if properly structured, the guarantee is just sort of splitting who is who. And so the interest rate investors are worried about prepayment risk and bringing capital there. But you still would want credit investors who are on the hook for the losses of the loans that are made. And I think most of the reform proposals that have been out there have this idea that there would be folks investing in credit risk, and there'd be folks investing in interest rate risk, and they could be the same, but they don't necessarily have to be the same. It's just making sure that there's enough there's enough of them, that they have enough skin in the game, that the capital is sufficient, and that there's punishment for when you make bad mistakes. And that's the problem of
well, I think that's the critical point, and I agree there has to be a regulatory framework. But fraud, by its nature, is hidden until it's not. Yeah. And fraud will always overcome regulatory frameworks because there's always going to be some people that find a way to hide it until they get caught. So I think you have to have, and in the business I came out of, insurance, we would have attachment points that always left the one who wrote the business on the hook up to some meaningful level. Enough of a level to drive them out of business if they made real mistakes. And I think that's the key here, is the attachment points either on a per-risk basis or on an aggregated basis, however it's defined, they have to attach at a high enough level that all of the market participants at the primary level, the lending level, at the secondary level, they all have to be primarily responsible, it seems to me. And the third part, the reinsurance part, is really just meant to protect our economy from a meltdown like we had in 2008. Thanks very much. I look forward to exploring it more with you, and I yield back.
Absolutely, same.
The gentleman yields back. The turn now recognizes the gentleman from Missouri, Mr. Clay, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Bright, for being here. Ginnie Mae's guarantee fee is capped in statute. Should Congress be considering legislation to raise or eliminate the cap? What would that do?
If Congress eliminated the cap and gave Ginnie Mae the authority to operate a little bit more like other regulators, where we could set the price and use those funds for risk management, Ginnie Mae would likely have the effect of being a even more sophisticated risk management operation than it is now.
I see. Let's shift to another subject. You know, and I'm looking at the intersection of housing and student loan debt. You know, that's a barrier to a lot of younger Americans who are strapped with student loan debt. Was wondering, would Ginnie Mae have any interest in backing mortgages that say, and it's been tried on a small scale in the country as far as folding student loans into 30-year mortgages. Would you all have any interest in that?
Wow, I have not.
Are you familiar with that?
Yeah, I would say this. Student loans are not my personal forte. I have heard the idea of explicit backing on ABS being something that folks have talked about. You know, and if that were to be the case, we'd be glad to explain to you the mechanisms for explicit, how our backstop works and whether it can be applied to ABS. I mean, I would make the point that an explicit guarantee fundamentally changes the way the market views an asset class. I mean, it changes everything. And so I'd be very happy to help explain to you the way it shifts the way global investors look at an asset class and the way that has downstream effects for the economy. I mean, it doesn't just have the effect of lowering rates. It is a fundamental sort of shift in how goods and services are allocated inside of an economy. So we would want to kind of talk through all of that.
Yeah, perhaps we could have that conversation offline someday.
Yes, sir. At any time.
One more question. The PATH Act would reduce the FHA's guarantee from 100% to 50%. The CBO has reported that this would seriously impair the value and liquidity of Ginnie Mae securities. Can you elaborate on how this would detrimentally impact Ginnie Mae?
Well, let's see. I guess I'm not.
Are you?
I wouldn't. Yeah, it's been a while, but it is worth noting that in the VA loan program, the guarantee is only 25%. So FHA guarantee is 100% of the loan. The VA loan program is 25% of the loan. And in Ginnie Mae securities right now, about 40% of our loans are VA backed. So, and they're all fungible. They all are blended. When you buy an MBS, you get some VA, some USDA, some FHA. And the VA loans do have a cap at 25%. I will also say that Ginnie Mae knows that this presents additional risk to Ginnie, because if there were, for example, we were looking at this in Texas, you know, if you have an issuer that's VA concentrated, and we have a lot of issuers that are VA only, and they're concentrated in one area that gets particularly hit, That guarantee goes away after the top 25% of loss, and so the likelihood of an issuer insolvency is greater. So it's kind of, we do have a program that does it. It does pose additional risk.
I see. All right. Well, thank you very much for your responses, Mr. Chairman. I yield back.
The gentleman yields back. The chair now recognizes the gentleman from California, Mr. Royce, for 5 minutes.
Thank you, Chairman, very much. Appreciate it. This discussion that we're having here on reshaping Fannie and Freddie, and you also hear this talk about reshaping them into utilities, and that given history is concerning in that obviously we had a moral hazard problem there. Wouldn't that approach simply bless the entities then as too big to fail? And wouldn't it also crowd out private capital, thus making it a lot harder also to price risk?
Well, I would definitely say that, yeah, it does depend on some of the proposals. I do think would probably not eliminate implied guarantees because the enterprises, would still perform a lot of the functions that they do now. And so in the Ginnie model, we have issuer and master servicer and credit risk taker, and they're separate, they're disaggregated functions. If those functions are all with one entity, the likelihood of being able to resolve that entity is substantially more difficult, and so yes.
As an alternative approach, some have been critical of the idea of Ginnie Mae playing a larger role in housing finance, as you know, but that's the other direction to go here. And the two concerns that we've heard are, first, because Ginnie is within a HUD, it doesn't have the capacity to play a bigger role. The second argument you hear is that the False Claims Act comes into effect, so banks' potential legal liability, therefore, are in play. How would you respond to those concerns?
Yeah, it's interesting because when I came to Ginnie, I had heard some folks say, well, we don't like the Ginnie model, and so one of the things we did was say, well, we're going to try and we want to run this agency well, and we want to be a good counterparty, and we want to have good counterparties, so let's figure out what it is folks don't like about it. When you start to peel the onion back, a lot of the concerns are really FHA-related concerns. And so the False Claims Act are really FHA-related. Technology upgrades turned out to actually be FHA-related. And so there are some things that Ginnie needs to do in technology modernization, like all of it, like every institution, and we are doing them. And I think we're right where we need to be on that. But some of the initial concerns were really more FHA than Ginnie.
But you'd think you have the capacity to handle it?
Yes, I mean, I think it would be nice to be able to, I would like to talk to you, if we're going to do that, about salaries and expenses and how that gets, whether appropriated or we can set those ourselves and all that kind of stuff. That would be part of the conversation. But certainly technologically, there's no impediment to it whatsoever.
Let me ask you a three-part question here. Do you think that credit risk transfer at the GSEs is bringing more private capital into play? Would be the first question I'd ask you.
Yes.
All right. Do Ginnie, Fannie, and Freddie have the legal authority to do more, including increasing the front-end risk sharing?
I believe so, yes.
You think they all three? And finally, have you seen the legislation that Gwen Moore and I have introduced that would call on the GSEs to increase the amount and the type of credit risk transfer transactions to the maximum level that is economically and commercially viable?
Yes, I'm familiar with it.
Yeah, do you support that legislation?
I think credit risk transfer is the biggest success story in the secondary mortgage market of the last 5 years, and so anything that you can do to lock in those gains, I think, would be smart.
Now, let me ask you on the topic of a common securitization platform. As we look at potential reforms, is a bigger role for the CSP and Ginnie mutually exclusive, I would ask you? Or can these two work in tandem?
They can absolutely work in tandem. They are
Explain how you would do that.
That's right. I have 39 seconds. So the CSP, there was a vision for what it was going to be in 2012, and I'm very familiar with the vision because I had the pleasure of working next to Ed DeMarco for over a year. I don't even think FHFA, they say that that vision is not really what it is right now, and that was intentional. So it has evolved into being a bond administration platform for use by Fannie and Freddie. So that's not a CSP, that is a dual bond administration platform. We use Bank of New York Mellon for government-insured loans as our bond administration platform. It would be very operationally not difficult to say, well, we'll have a Ginnie 2 that's bond administered by BNY and a Ginnie 3 that's bond administered by CSS, and that exists for a little while, but they're both full faith and credit, no problem. Then the next step would be, how do we blend them? And to blend them, you would align day count conventions so that everybody pays on the same date. You would align disclosures so that everybody gets the same disclosures, and you'd pick one of the two bond administration platforms, and that could be a decision that would make sense to do 5 to 10 years down the road, because CSS is barely even, it's brand new.
And you have a lot more room for private capital to go back in. Thank you, Mr. Bright. Thank you, Chairman.
The gentleman yields back. The chair now recognizes the gentleman from Pennsylvania, Mr. Rolfes, for 5 minutes.
Thank you, Mr. Chairman. Mr. Bright, the 2014 Ginnie Mae paper, An Era of Transformation, described the changing mortgage lending and servicing market and its implication for the corporation. The author wrote, quote, "The retreat of commercial banks from mortgage lending and servicing and the replacement of this capacity by non-depository institutions with more complex financial and operational structures represents a significantly different operating environment than that for which the program was originally designed." A 2016 research report from Ginnie Mae cautioned that these non-bank lenders and servicers were riskier than traditional banks. The author warned of a worst-case scenario in which, quote, "a rise in delinquencies could threaten multiple non-bank firms at the same time, causing industry-wide panic." What has Ginnie Mae done to address this shift in the industry?
Yeah, thank you. Well, I don't agree with everything in that paper on one level, and number two, for what it's worth, and happy to talk about that. Number two, we have taken many, many steps and are going to be taking more to address the concerns that I think are valid. So the first is that are non-banks riskier? That's not really the right, I don't know that I fundamentally buy the premise. I mean, both banks and non-banks have a servicing strip that's the same size, and there are some non-banks that are simply more operationally adept at servicing than some banks are. Because they're legacy-free, this is what they do, they're very good at what they do. And so a balance sheet at a lending institution is not a panacea to risk. It doesn't, and we should not treat a large balance sheet as a panacea to risk. So I think that the entrance of non-banks can actually be good if we get it right. The second step is risk management of those institutions. And so Ginnie has put in place a liquidity requirement, which is quite substantial in terms of the amount of liquidity that the issuer needs vis-a-vis the size of their balance sheet. And that is a very important step in preventing any sort of liquidity run where Ginnie Mae would face risk. And then the third step, and this is one that I think has a lot of excitement and ongoing promise, and we're working on it next year, is that there are a lot of large money center institutions or large asset managers that have interest in financing or in having the economics of the MSR, but they don't want to be in the operational business of servicing delinquent loans, and which is fine. And then there are a lot of non-bank servicers that want to be in the high-touch business of servicing delinquent loans, non-performing loans, but they don't have large balance sheets. And so we're looking at sort of marrying these two investor classes in some structures so that we can have lots of capital standing behind the operational efficiencies at a non-bank servicer. We've taken some steps in releasing something called an acknowledgement agreement, which allows issuers to take their MSR and get financing on it. That's a first step. There are improvements that we're going to make to it, but it's interesting. I actually have a line of large asset managers and money center institutions out the door that want to be in the business, but they don't want to be in the operations business. And so we're kind of working to blend the two.
How would you respond to the HUD OIG report from September 2017, saying that Ginnie Mae did not respond adequately to the changes in its issuer base?
I think that's a little unfair. I think that's
the IG was unfair.
What's that? I'm sorry?
The IG was unfair?
I think so. I mean, I think that Ginnie Mae is important to remember that we are a taker of the volume from VA and FHA. So there's some amount that we do not actually control. We can police the program, but we can't set G fees. Ginnie Mae can set entry requirements for the program, but they need to be universally applied, right? You can't be arbitrary and capricious on that. So that there's some level of unfairness in the report. But that doesn't mean that I don't think Ginnie should have waived in everybody that it did. Okay, so we do have a lot of issuers right now who came in the time period between 2013 and 2016, and Ginnie spent a lot of time and a lot of money going through the application and through the process, and the issuer was, all hot on being an MSR owner, and it was a big interest rate trade, and they thought it was the trade of the day, and then, they get in and realize this is actually really hard work and dirty work and operational work, and so they're not so interested in it, and now they have a legacy runoff book that just kind of sits there. And, in hindsight, probably some of those issuers shouldn't have been allowed into the program. And so going forward, when we look at allowing issuers into the program, you really ought to be someone who's committed to being a servicer, committed to the long-term business of being a mortgage servicer, not just, servicing IO is the hot trade of the day, and so we're going to go be a Ginnie issuer. And I do think some of that took place, and those concerns are probably accurate and valid.
Thank you. Yield back.
The gentleman yields back. That concludes our questions today. Mr. Bright, thank you for your testimony and your insight. Without objection, all members will have 5 legislative days within which to submit additional questions to the chair, which we then forward to you. Mr. Bright, we'd ask that you respond as promptly as possible. Again, I want to thank you for taking your time and providing your insight to this committee, and we look forward to continually working with you as we go through this process. With that, and without objection, this hearing is adjourned.